The piercing pattern is a two-candle reversal pattern that is occurring at a market bottom only, making it a bullish reversal pattern. The price action leading up to a piercing pattern must be a downtrend. Ignore the pattern in a sideways or an uptrend. Price must be trending downwards. The first of the candles has a real red body and color as it continues the trend downward. The bears continue to drive prices lower. The second candle is a green candle opening below the real body of the first candle. So prices close low on the first red candle here. And then the next morning gaps down below the lowest point of the red candle to open here. The second candle then closes above the midway point of the red candle, as seen in the diagram here. The 50% line marks the midway point between the open and the close of the red candle. So the green candle must close above this point. Confirmation of the pattern is price trading above the high of the green candle here, and as always, more conservative traders might wait for a complete candle body close above the high of the green candle or even above the high of the red candle here. Now, let's look at the psychology of the piercing pattern to see who's in control, the bulls or the bears. The first candle continues the downward trend and everything is looking bearish. The second candle ideally gaps down at the open here. However, price hits an area where the bears are no longer willing to come into the market at these low prices, as well as those who were in a short position. They might be looking to cover their position and take some profits. Also, it is at this point that the bulls find these low prices attractive and enter the market in full force. The balance of supply and demand has now tipped in favor of the bulls. Buying increases and the price rises. The key to this pattern is the upward move and close above the 50% level of the red candle here. This is considered the balance point for bullish and bearish sentiment in the first red candle. On the second candle, the bulls were able to push the price back up and then close above the central balance point of the red candle. This move could potentially shake the confidence in the bears and motivate them to exit their position upon confirmation above the pattern here. This could also potentially be a good entry point for the bulls looking to trade a long position in this stock. Remember, as always, you will never be 100% correct. But with knowledge and understanding comes rules, and it's the discipline of following these rules that will ultimately make you successful. Now, let's look at how the process of candle addition will take a two-candle piercing pattern and combine it into a single candle. The piercing pattern is made up of one area of price action being with the red candle that opens here, goes to the high here, and then to the low, and then closes here. Followed by price action in the second candle, gaps down and opens here. Goes to the lowest price, then to its highest price before closing here. All of this price movement is represented in this one candle here on the right. The body opens here, which is equal to the open of the real body here on the first candle. The body closes here, which is consistent with the close of the second candle here. Additionally, the high is equal to that of the piercing pattern. Also, the lows are the same. Question: being that this occurs at the bottom of a downtrend, through candlestick addition, a piercing pattern now becomes a, anyone? Anyone? Bueller? Jenkins? Becomes a red hammer, a bullish reversal pattern. If you missed that and that got by you, you need to go back and look at some of the earlier videos. But yes, a red hammer. So if you're looking at any price action and you want to know who's in control, the bulls or the bears, use the process of candlestick addition, turning multiple candles into one, and see what insight that gives you. Now, let's come to everyone's favorite part, looking at a few examples. I don't know if you realize it yet, but by now, if you've been following our series, you are reading charts. Here, we have a downtrend leading into a piercing pattern with confirmation of price trading above the pattern, a bit sideways for a few days. Again, every pattern is not going to be textbook before it really takes off, uptrending for a bullish reversal. And on this chart, we have an example of a textbook piercing pattern. Let's go down the list. We have a trend, check. Downtrend. We have a pattern, check. Piercing pattern. Proof of this is the red bearish candle, followed by a gap down on the open. Then we have a bullish candle that closes above the 50% level of the previous candle. I forgot to add number 6, confirmation, but yes, we have confirmation. And then a bullish reversal trend ensues. And finally, on this chart, we have a very strong downtrend that tries to bounce, but failed until it ran into this beautiful piercing pattern. Now, I broke this one down so you would have an example of how to get money with this pattern. Now, after the second candle gaps down at the open and then closes above the 50% level of the red candle, we're sitting like snipers waiting on confirmation before we pull the trigger. Now, being an aggressive trader, as soon as the price starts trading above the pattern, I'm entering the trade for a long position. And because I know that I'm not going to be right all the time, I make my stop for a small loss to be if the price comes back down below the green candle, as this will probably indicate a failed pattern. I also set my profit target to be in the area of the last bounce attempt, locking in some profit. Don't worry about trying to control your wins. Controlling your losses will allow you to live and trade another day. Well, that's all, folks.